Well, everybody, thank you for coming, for attending this webinar. Um, I usually have a short disclaimer. Um, so I want to briefly highlight the disclaimer. This presentation is intended purely for informational purposes. Nothing shared tonight should be taken as investment advice. We always encourage our prospective investors to consult with their own financial advisors, attorneys, or tax professionals before making any decisions. Additionally, please be sure to truly review the full set of offering documents that you can access by scanning the QR code at the end of this presentation. Our core approach is transparency and education. Our goal tonight is to help you understand this opportunity clearly so you can make an informed decision aligned with your goals and risk tolerance. Before we get into the details of this project, I just want to take a moment to highlight what truly drives the success of an investment like this. It's not just the asset or the numbers, it's the people behind the project. In this business, execution is everything. Having the right professionals in place, individuals who know this market, understand the asset class, and have the track record of sound decision making is what gives us the ability to manage risk and deliver results. So now I'll turn it to the rest of the team to introduce themselves. So Charlie, you go first.
Thanks so much for having us, guys. Appreciate you joining us for the evening. My name is Charlie Peters. I am the key principal on this project, which we are very excited about. About me, I bought my first multifamily property in 1996, and I've been an owner and operator of multifamily properties for the last 29 years. Over 3,000 units over my career, and currently I'm an owner in over 2,000 multifamily units. This will be my 39th multifamily acquisition. I've gone full cycle 19 times, meaning a purchase, a reposition, and an exit. I've done that 19 times. Very proud to be able to say I've never done a capital call and I've never had an investor lose money. So, you know, it's a small track record, but I'm very proud of it, and hoping that that'll continue with this project. Delia?
Thank you, Charlie. Charlie's our star. But yeah, my name is Adelia, and I have been in real estate for quite a while, from the investor side, actually, through a family office and private banking. So managed assets, bought buildings, all kinds of stuff like that. And along with Charlie's resume, I think we are the perfect pair to lead this team to greatness. So we look forward for you guys joining.
And that's an impressive accolade, I tell you. Thank you both. I'll talk a little bit about myself. I'm Charles Weiner. I'm based in Fort Myers, Florida. I have spent over 4 decades building and leading businesses, including as president and CEO of a NASDAQ traded company. My focus today is entirely on large multifamily real estate across the Sun Belt states. Over the past 3 years, I've been involved in more than 500 units with hands-on roles in underwriting, asset management, and raising capital. I serve on the board of 2 companies and also support causes close to my heart, such as children's hospitals and housing initiatives. My mission is simple: to create long-term value and help others build wealth through smart, well-structured investments. Brandon, go ahead.
Yeah, how you doing? My name is Brandon Murray. I've spent 12 years in the private sector working for BlackRock Financial Management on the institutional side. I'm more focused now on acquiring a multifamily portfolios. I currently own units out of Texas. I'm always looking for strong value add opportunities and looking forward to working with all of you. Thank you.
Okay, Jimmy, next.
Yep. Hey guys, thank you everybody for joining. My name is Jimmy. I am a commercial real estate broker from New York City. About 6 years in, and I've closed a lot of deals, over 150 transactions, represented over 40 different businesses. Find space, negotiate, background in managing properties, leasing properties, selling properties. Recently transitioned into multifamily investing. Actually, just closed on 44 units, not too far from the property that we're going to be discussing. I'll be sharing some insights on that later. But yeah, excited to be a part of the team and looking forward to jumping into this deal.
Okay, well, I have a little bit of a slight malfunction here, but Noah, introduce yourself.
Yes, my name is Noah Sanders. I live in Apollo Beach, Florida. I'm about 40 minutes away from this property. I've been in multifamily real estate for almost 25 years. I've invested in over 300 units, but I specialize in construction and doing rehab. So I'm able to get into these units and on properties like this, value add properties, and I'm able to get in and do the improvements to add value and do it with great speed so we can get new tenants in at a higher rent and start adding value to the property and giving great returns to our investors. I'm very excited about this deal, and we have the A team, basically. We have a dream team, as you can see, very, very qualified, very experienced people in our team, and I'm excited about this deal.
That is great. And we have Lucas also. Unmute yourself and introduce yourself.
Hello, my name is Lucas Jensen. I'm from the Seattle, Washington area, and I am an electrical engineer by trade, but now jumping into real estate investments. And this is going to be one of my first few raises for this deal, and looking forward to it because this is a great opportunity. So.
That is great. So I have a little bit of an investment overview. Noah, if you want to take it from here.
Absolutely. So it's 90 units. It's in St. Petersburg, Florida. St. Petersburg, Florida is a great area. Many people know it has some of the best beaches in the country, great dining, shopping, the culture, the weather, unbelievable, and it's affordable. And all those reasons are why people want to live here and why people are continuing to move to this area. Matter of fact, in the last 5 years, this area has grown over 11%, and many people think it's going to continue to grow at this rate or even greater. So the area is wonderful. It's an amazing area. It's 90 units. 90 units is a great number. The asset has a lot of potential. This asset is currently owned by someone that debt on there that was a variable rate debt. So his debt service has got out of control with the way that rents went, the way that rates went. So his debt service is very, very high, and he's not able to take care of this property the way it should be. So there's a lot of room for improvements on this property as far as cleaning up the grounds, the grass, the pool, and several other things. And by doing these things, we're going to be able to get a lot more interest in this property. Because he wasn't able to do this, occupancy has fallen to 92%. Typically, this market should be between 95 and 97%. So when we get this thing and get it going the way it's supposed to, get the property the way it should look, we have plans on doing improvements to the grass, to the pool, adding different amenities, these things, and being there to really tend to the tenants. So there's not going to be any deferred maintenance. There's not going to be any calls that are going to go without us getting to it right away. So anyone has a problem, we're going to jump on it right away. And this is what's going to make tenants feel comfortable. And this is what's going to bring more tenants to the property. So we're going to increase occupancy. We're going to increase rents because there's a lot of areas here where we can do improvements. And because of those improvements, we'll be able to raise rents. By raising rents, by increasing occupancy, we're going to be able to increase our NOI, and we're going to be able to give great returns to our investors. So we got a really defined game plan, business plan that we're going to execute, which is going to provide us the type of NOI, the type of returns that our investors are looking for. We've targeted right now, you can see here, it's at 1.97, which really is like a 2x over 5. It means we'll double your investment over 5 years is what we're targeting to do. And while we're doing that, we're also going to be giving out regular distributions. So you're going to be collecting money along the way. And over 5 years, you should double your money. But one of the greatest things is the tax benefits. So we're going to do a full cost segregation study, which will get passed down to the LPs. And if you invest $100,000, you should get about a $50,000 tax credit next year. And most of the time, that will eliminate most people's taxes. So $50,000 the next year on a $100,000 investment. Also looking to take the 100,000 to 200 over 5 years with the distributions and with an exit. So the deal got great returns. It's got great potential. The market's an amazing market. You know, the market's growing. There's a lot of organic growth in this market because so many people want to live here. And with all the people moving here, there isn't enough supply to fulfill the demand. So because of that, rents are going to go up just because of the strength of the market. And we're also going to increase rents because we're going to be able to manage the property better, and we're going to do improvements to the property. So with a combination of all those things, this is a very, very strong, a very, this asset right here is going to do very, very well because of those reasons. And that's why I'm really excited about it. I've looked at this deal up and down, and there has so many things that I like about this deal. Very, very excited, and can't wait to get started.
Yeah. Hey, real quick, Charles, can you go back one slide?
Sure. We're back.
I just wanted to mention, guys, first off, it's critical. If there's one slide in this presentation tonight that you need to drill in on, it's this one. If we execute the business plan, this is what can be expected. We've got a pretty darn good track record of executing business plans. That's it. If you have any questions about any slide tonight, there's a Q&A prompt at the bottom. Or actually, there's a chat at the bottom.
Right.
If you just scroll down to the bottom, just put your questions in the chat. We're going to have a Q&A at the end. So on this slide or any other slides, any questions you have, feel free to drop them in there. We're happy to address everything that you guys that's on your minds tonight.
Yeah,
Yep.
I briefly wanted to add, I mean, the same subject. He mentioned about doubling your money in 5 years. Imagine that if you have a really good CD account right now at 4.5%, it will take you 18.5 years to double your money, just in comparison. Basic math.
Excellent. All right. Thanks.
Jimmy, you
Sorry
want to talk
the-
about, yeah, Jimmy, you want to tell us a little bit about St. Pete?
Yep. So St. Petersburg, Florida. I'm sure everybody here knows it as a nice beach town, but it is a booming market in terms of job growth, inbound population growth. A lot of these notable markets in the country were kind of known as getting a little bit overbuilt in the previous years. And it's true for a lot of the main markets. St. Petersburg is right in that sweet spot now where we're at this perfect timing of this upswing where we're getting in on a property on day one that is cash flow positive, and all the metrics and signs and analytics are pointing to no slowdown in population or economic growth. And that's just going to lead to a cap rate suppression. So over time, these properties are going to become more and more competitive in this market as becomes more sought after by investors. So couldn't say enough about this this area here. So you can see where Armature Square is located here on the peninsula. Very good location. So right to the east, you have downtown St. Pete, probably 15-minute drive. And then you have some of the top beaches in the country right there to the west. Tons of employment. It's a much needed area for workforce housing. So I am actually a co-owner on a property that is a little bit south there, down 275. And essentially this property, as you guys have heard before from Noah kind of hinting on, it's been a little bit mismanaged by the current owner. Imagine you're living in an apartment complex and they're late on fixing your AC, your fan's been broken for a while, they're not answering, there's trash in the yard, the garbage isn't getting taken out, the pool's broken. These are like frustrating small maintenance issues that make a big difference to the quality of life. And it's a really easy fix for a team like ours to just come in there. We're going to hire one of the top property management companies in all of Tampa, St. Pete, called Starka. And it's actually a property management company that I use on my other property nearby. And they've done a phenomenal job just coming in, getting everything cleaned up, getting market rate leases done, keeping occupancy high. So the fact that this property is even at a 92% occupancy now, the fact that it's being run pretty poorly, I think for me, just speaks to how nicely finished the interiors are, how good of a location it is, and people want to live there. They're dying for better management. So you can kind of see the overview here. 90 units, 92% occupied. 1983 construction, concrete block, which is great, especially for this area in Florida. Yeah, I think that's it.
That looks great. Yeah, there's some additional opportunities. What makes this opportunity compelling isn't just the potential to increase the rents, it is the multiple levers we can pull to improve performance across the board. First, we have identified several operational inefficiencies, areas where costs can be reduced without compromising quality. That includes things like, whoa, my slide disappeared there, something happened. Sorry, a technical issue. I was talking about identifying, renegotiating service contracts, optimizing utilities, and reducing turnover through better, resident experience and being more responsive to their demands. On the income side, we will introduce and improve revenue streams such as assigned parking, pet rent that's not being collected right now, cable and internet packages, valet trash, and we're exploring other potential amenities to enhance both the residents' satisfaction and our bottom line. All these will be professionally managed, like Jimmy mentioned, by a property management firm with deep experience in this asset type and market. Combined with our team's hands-on oversight, we see a clear path to significantly improve both net operating income and the overall asset value, and also delivering a great experience for our residents. Charlie, if you want to talk a little bit about the underwriting and this property.
Yeah, you guys. So, how do we know if a deal is a good deal? We touched on a lot of this already, and these are relatively simple fixes. If you go over there and look at the property right now, there's trash everywhere in the parking lot, on the grounds, and all you got to do is pick it up. So it's not, this isn't what we're doing is not rocket science. But as we're underwriting the property, we do a couple of things that I like to think maybe differentiate us from what other people do, and that is starting off, we underwrite the property based on, it's called a T12, which is a trailing 12-month profit and loss statement. So we use the existing numbers that are in place right now, as opposed to, the broker's pro forma, as opposed to the broker's projections for what it could be. We want it to actually be there. And so the day we close, the property will be cash flowing. We're at a 1.3 DSCR, which means we're going to have 30% more than the mortgage payment left over after we make the mortgage payment each month. So the property is going to cash flow on day one. We love that about the property. In addition to that, since we put the property under contract, we've kind of pushed them to increase the rents there a little bit, and they're already renting units at our year one projections. Like, we're already there. So that is a great sign. When we underwrite, we factor in both economic and physical occupancy. So not just units that are vacant, but we also take into account tenants that don't pay rent. And there's always kind of a small percentage of tenants that do that, but we factor that in as well. We're going to have reserves in place. We have the property 92% occupied right now. Before it gets to a point where it breaks even, 74% is the current 74% occupancy is the current break even cash flow, and then 68%, which is the end of year one, once we're stabilized moving forward. So we can have, hopefully we don't get there, but we can have 25% vacancy of this property and still be covering all expenses and the mortgage payment and everything be fine before we ever had to dip into reserves. So that's some of the conservative underwriting that we do as we take this on. And then we did not model in a refinance in our underwriting, but if we do a refi, if the opportunity presents itself, we'll probably do a refi around year 3, and that will just boost returns that much more. Once you get all your money back, your return on your money goes to infinity. So, yeah, so we got a huge opportunity to outperform the numbers that we're putting in front of you here tonight.
That is great. I think Noah can explain us a little bit about the financing plan.
Yeah, so we've got agency debt with Fannie Mae, and we are borrowing money at 5.8. That's the interest rate that we're going to be borrowing at. But we're getting this asset and it's at a 6.8 cap. So going in, we're at 100 basis points of positive leverage. That means the deal is cash flow positive day one. To find an asset in this market that's cash flow positive day one is very, very difficult. Most people, when buying assets like this, are going in negatively leveraged. They have to execute their business plan by doing the improvements in order to get this thing, their asset, to be positively leveraged. So we're already starting ahead of the game. Now that this asset makes money, right when we take it over, we're going to continue to do improvements, raise rents, and even increase the amount of cash flow that this asset is going to be kicking out. And that's really good to our investors, because going in, there's already going to be returns that your money's already working for you. But as time goes on and we're able to execute our business plan, you're going to get stronger returns, because we're going to raise rents, and this asset's going to start making more money than it already does. So we're going in at a great stand as far as financing, cost segregation. We're doing the cost segregation study. So all of the bonus depreciation is going to be passed down to the LPs, to the limited partners. So that's where you get your tax credit. I think that's it for this slide.
Charlie, you explained that cost segregation last time very clearly. You want to give it a try?
He touched on it great. It's all everyone needs to know. We are doing a cost seg study. When you buy real estate, you get to depreciate the value of the real estate. If you do a cost segregation study, it breaks up an apartment complex into units plus all the stuff that's in the units. So like a refrigerator, you can depreciate over 5 years. A stove, you can depreciate over 5 years. So we break out all the appliances, water heaters, flooring, window treatments, and all that stuff can be depreciated much quicker. And so they go on separate depreciation schedules. And at the end of the day, as Noah said, if you make $100,000 investment, you can expect a year one paper loss, and that is a paper loss, not an actual loss, of about $50,000. So it's one of the great reasons to invest in real estate. If you have any specific questions about the cost segregation or bonus depreciation, feel free to drop them in the chat. I could talk for 30 minutes about this, but we want to be respectful of your time.
Okay, I'll talk a little bit about the fee structure. We're trying to be very transparent on this part. Our compensation is fully aligned with investor success. We offer an 8% preferred return, followed by a 70-30 split.
Hey, real quick, that 8% return. So if you put in $100,000, you're going to earn a guaranteed 8% on your money. The GP does it. The general partner, investors are the limited partners. We are the general partners. The general partners don't make any money until you guys get your 8% preferred return. And then after that, each dollar that comes in is split 70-30, with 70% going to the investors, and then we get the 30%. So we are heavily incentivized to make sure that this works out to everyone's benefit. I'm sorry,
Definitely. No, that's great, because the investors still need to understand that they have priority. They get paid first. We don't get paid anything if this thing doesn't perform really great. That's the incentive, like you mentioned, for us to make sure that this business, actually the business plan, is executed properly. There's no hidden fees here, no surprises. We keep this very simple and transparent. We trust the foundation of this great partnership between the sponsor team and the investors. There is an investment timeline, and it's not always perfect. These things, we're going through due diligence right now, and there were certain delays and then paperwork that we need to comply. What I want to mention here really is that this is a time-sensitive opportunity. with key milestones already underway. From the PSA and due diligence to the capital raise and the closing, it's unique. It's a limited offering in a strong location. Has a great demand. We've been accepting investors for a while on a first come, first serve basis. So what I recommend is, when I show the QR code, that's a link for our data room for the cash flow portal. Go in and register so you save your spot, and then once you understand this the deal and all your questions are answered, you can go ahead and just complete the necessary paperwork, and you can move forward and invest. I think that we're going to show that this slide twice, and it's on purpose because it's very important. So Charlie, if you want to go over really quick again.
It's once again 8%. 8%. You get an 8% preferred return on each $100,000 that you put in. That also worked out to about an 8% cash on cash return over the life of the deal. The average annual return 19.5%, and then that EMX, that stands for equity multiplier. So that's what you get back in this case, it's $100,000 investment, and that's linear. So if you put in $1 million, that would be 1.97 million coming back to you. You understand. But yeah, that's it. If there's any specific questions about this slide or any other slide, feel free once again to drop them in the chat, and we will address that in about 2 minutes here.
Yeah, I think that we won't bore everybody. There's some questions coming in. First of all, I thank you everybody for attending and for listening to us. Again, that QR code is the access to our data room, to the cash flow portal. You need to register the first time before coming in, put your username and password, and it has all the details, all the paperwork, the offering memorandum, everything from, for this deal. Again, on the Q&A, I see there is questions already. Charlie, if you want to take a look, and the first one, will we have to pay recapture taxes on the depreciation at the point of sale?
So yes, when we sell the property, everybody should hopefully get a very nice payday at the end of this. And the question is, will we have to recapture taxes on the depreciation at the point of the sale? The answer to that question is yes, you will, but you can reinvest the gain into another deal. And real estate guys kind of do this. Usually if a deal works out, there'll be another investment which will come after that, and so you will have the recapture, but you can offset that just by investing in them.
Okay, there's another
offset it at least partially.
Right. The next question here is, what is the AAR?
AAR stands for average annual return, and so in this instance, we're roughly doubling money in 5 years, so that's a 100% return on your money. If you divide 100 by 5, you get a 20% average annual return. So that's the average return over the life of the deal.
Okay, there's another question here. What is the minimum investment?
Minimum investment is $50,000 for this one. No, it's not.
Okay.
What is it? 100,000?
I think we put 100,000 on
100,000. Apologies, 100,000. Okay.
There's another question coming in. How does AAR differ from IRR?
AAR is the average annual return over the life of the deal. IRR is the internal rate of return. So that's a compounded rate of return, if that makes, you're getting into kind of some math stuff here, but basically if you start with $100,000 and you increase it, for this example, it's 16%. You'll wind up with $116,000 at the end of the year, and then it compounds again at 16%, but you have a larger amount than you started with. So the amount that compounds is greater, and then it compounds greater and greater and greater each year. That's compounding on your money. So if you had an investment where you were earning 16% annually each and every year, it would roughly double in 5 years, which is what, even though you have a 20% annual return. I hope I explained that well.
That is great. We have a question here is, why invest now?
Why invest now? Who wants? You want me to take all of these, or?
Yeah, I think we can spread them. Noah, if you want to take that one, or we can spread them
Market
out.
cycle's great right now to buy. But there's a couple of different reasons. For one, right now, sellers that have to sell, like in this situation, is a distressed situation where the seller, when he bought this asset, he bought it with floating debt. So he had a variable rate debt, and his debt service has gone up because rates have gone up. And because of rates increased, he's forced to sell it.
Yeah, you guys, we talked about the conservative underwriting that we do. This guy paid 180,000 per unit for these units. We're buying them for 162. And after he bought them, he renovated the units. So he's got an adjusted basis of somewhere around 190. We're taking great advantage of that and buying this at a much lower basis.
Yeah, because rates are higher. When rates go higher, the values go lower. When rates go lower, the values go higher. So now that rates are high, the value is lower and he's forced to sell. So now we're picking this asset up, like Charlie was saying, $20,000, roughly $20,000 less than what he paid for it. So we're coming in at a great cost basis. And most people think that over the next 5 years that rates will decrease. So if rates go down, the value of the asset's going to go up. We don't put that in our underwriting. That's just extra bonus on top of that. But the market cycle is great now because for a long time, it was the seller's market. People were buying 3 and 4 caps and sometimes lower than that. It was getting very, very competitive because debt was very cheap. Now it's not like that. So it's a buyer's market. Sellers are selling because they have to, and buyers are picking up deals, but there's still some buyers on the sidelines just because they can't make deals happen or they don't feel like it's a good time for them to get in because they don't understand the market like we do. Charlie has been in this for 29 years. Like he said, 38 deals, 19 full cycles, and has never lost investor capital. So now is a great time to buy. This is a great market to buy in. And these are some of the great reasons why this is the perfect time and this is a perfect asset. We're in a great market, and buying it at this price, we're going to be able to do really, really well. We're going to increase the value by raising rents, by organic market growth, and we think rates are going to go down over the next 5 years. So these are all very important reasons why we think right now is the best time to invest in multifamily real estate.
Yeah, if you just Google interest rate forecasts, and they should be, we think they're going to be declining. You can make the decision on your own, but we think they're going to be declining over the next, call it, 3 to 4 years here. Another thing, when rates dropped to darn near nothing, as everyone knows, right after COVID with Fed stimulus, and all these builders brought buildings out of the ground. So there's a bunch of new units in St. Pete as well as in other markets around the country. When interest rates shot up, that building pipeline dried up. And so the forecasted deliveries are about a third of new construction projects, are about a third of what they were going to be a year or two ago. And so there's a supply and demand imbalance that we think we're going to be able to take advantage of over the next 3 to 4 years.
Okay, there's a couple of questions here on the Q&A that I didn't see. Thank you, Brandon. One here is, with being in Florida, hurricanes are always a major risk. What are your concerns, and has this property been hit by any hurricanes? Odilia,
That's a great
do
question.
you want to answer that one?
Who?
Odilia, you, Charlie, anybody that's familiar with this?
Well, we just got hit by 2 of the biggest hurricanes we've seen in this area in a long time. And even after the 2 hurricanes, we didn't sustain any major damage. A couple shingles were blown off the roof, but that was really it. So these units have been tested. The buildings have been tested, and we don't have any concerns of getting any damage from hurricanes.
Right. We want to talk about a little bit. We want to talk a little bit about insurance, because that's also a concern. Odilia, if you want to tell us about the insurance, what we found or what we have so far in place for this property.
Yep. We've been getting official insurance quotes, and we have insurance at about $1,100 per unit. And that's a firm price based on today's market. These rates have come down from a year ago where they were quoted at 18 or 2,000 per unit. This is not in a flood zone. Our building has, again, not a scratch with 2 hurricanes last year, and never been flooded or any water issues at all, or wind issues other than shingles or a fence, in the last 50 years that it's been built.
Yeah, that was a great question, and absolutely concerned being the
Definitely.
coastal market in Florida.
Yeah.
We actually have FEMA residents in the complex right now that were transplanted from other complexes to our place. So there you go.
Yeah. There's a couple more questions coming in here. It's only for accredited investors. That is correct. If you're not accredited, this deal is not for you right now. If you're accredited, it's fairly easy to get your accreditation on the cash flow portal. There is a button when you go in through the registration that asks you if you're accredited, and then it asks you for a way to prove that with a letter from your CPA or by providing your tax returns. There's another question here. If this presentation is recorded, yes, we can provide it later on. I usually post them on YouTube, and I can send it by request as well. There's one else coming in here. If you'll be able to do 2x in less than 5 years, is there any motivation to do so, or is holding for 5 years important for the brief returns?
No, if we're put in a position where it makes better financial sense to pivot a little bit, then we will do what makes sense. So yeah, if we can exit earlier and we feel like, market cycle is good, time to sell is good, the property is running pristine, there could potentially be an earlier or later exit. So 5 years is the target.
I think that's it. We ran out of questions here. I think some of the questions were excellent. And if anybody has any additional questions, this is the time. I put the link to the cash flow portal. It's the same as the QR code that was before on the screen. And again, I encourage you to go there early because we have a limited amount of investors on this deal and it's filling up fairly quick. Okay, so one more question just came in. How much is the equity raise? And it's $7 million. We're raising $7 million. The rest is provided by the bank. I will wait a minute here. If someone else has a last minute question, we thank you very much all for participating. Whoever invited you to this webinar can answer additional questions, turn directly to them. Once you click on that link for the cash flow portal, is a list of all the sponsors and you can select the person that invited you, and there is contact information as well.
Another
The
question
QR
popped up.
code. Whoops.
Yeah, the link that's on the chat is the same as the QR code.
Okay.
Yeah. And I
Another
think
question popped up. Do we have any Section 8 tenants in the property? Adelia?
Yeah, we have about 5 out of the 90.
not by choice. I mean, they're already there and we inherited them. So,
Yeah, but our property management is, I mean, we can't throw anybody out, but we are trying to upgrade the property, and that includes the tenants that live there.
Okay, we got some thank yous. So thank you all for coming. Thank you for the panelists for participating at this late hour, and we'll see you soon. I hope to see you as an investor.
Thanks, guys.
Thank you all for your time.
Thanks, guys.
Thank you, guys.
Thank you, guys.